The Shopify stock price on the Nasdaq is currently trading at $167.78 USD, showing a strong intraday gain of $6.05, which translates to a 3.74% climb for the day. While the headline figure of nearly 4% growth on a Friday morning looks like another routine victory for the e-commerce titan, the real story lies in a massive divergence between what the casual trader sees and what the institutional giants are actually positioning for as we head into 2026. Most investors look at Shopify and see a platform that lives and dies by the health of the consumer. But the reality is that Shopify has successfully detached its growth from the broader retail cycle. Even as general retail traffic dips in physical locations, Shopify is seeing an acceleration in merchant penetration that is effectively making them a tax on the entire internet's transaction volume. The expectation in the market right now is that the post-holiday cooldown will eventually catch up to Shopify stock, leading to a standard cyclical pullback. However, the reality of the data suggests something far more aggressive. Institutional activity has remained remarkably resilient, with nearly 70% of the total float held by large-scale funds, and we are seeing a shift where Shopify is being treated more like an infrastructure play than a discretionary retail stock. This is the curiosity loop that most are missing. If you think Shopify is just a website builder, you are looking at a version of the company that hasn't existed for years. Today, it is a global financial services engine that is processing billions through its own proprietary payment rails, and that is why the intraday movement is outperforming even some of the biggest tech names like Apple stock or Nvidia stock in terms of relative momentum today. When you look at the landscape of online investment and online investing today, Shopify has become the ultimate benchmark for how a software company can scale without losing its soul. Many people using investing sites or individual brokerage accounts, like those at Fidelity or Interactive Brokers, often ask if the valuation is too rich. They see the price-to-earnings ratio and get nervous, thinking the bubble has to burst. That is the common ground belief, the idea that the stock is overpriced. But if you challenge that with a contrarian view, you realize that the traditional metrics don't account for the massive tailwinds in their merchant solutions segment. Unlike a typical retail business, Shopify doesn't have to worry about physical inventory or the decaying value of storefronts. Instead, they are the ones providing the digital real estate, the payment security, and the logistics coordination for everyone from the small entrepreneur to massive enterprise brands. The recent stock movement has been a masterclass in holding support levels. We've seen trading volumes spike during these upward swings, indicating that it isn't just retail enthusiasm, but significant institutional accumulation. When the market opened today and pushed the price toward that 168 level, it confirmed a breakout pattern that has been forming since the last earnings reaction. In the most recent quarterly report, Shopify posted revenue growth of 32%, which is an incredible feat for a company of this scale. What really caught the eye of the big players at Schwab Intelligent Portfolios and SoFi Invest was the free cash flow margin hitting 18%. That was the 9th consecutive quarter of double-digit margins. When a company can grow its top line at over 30% while keeping nearly a fifth of every dollar as pure cash flow, it stops being a speculative bet and starts being a foundational part of a self-investing strategy. Macroeconomic pressures are always the elephant in the room. Inflation and interest rates are at levels that usually crush consumer-facing businesses, yet Shopify seems to be thriving. The reason is simple. The shift to digital isn't a temporary trend, it's the permanent state of global commerce. Even as physical store traffic declined by 2% on Black Friday, Shopify's global sales grew by 27%. This gap between expectation and reality is where the money is made. Analysts were expecting a slowdown, yet Shopify delivered record-breaking numbers, with peak transactions hitting over $5 million per minute. This level of operational reliability is why you see people on the Robinhood app or the Fidelity mobile app piling into the stock during every dip. It has become a perceived safe haven in the tech sector, which is a massive psychological shift from its earlier days of extreme volatility. Let's break down exactly what the company does for anyone who might be new to the Shopify stock story. At its core, it provides the essential tools for anyone to start, grow, and manage a business. This covers everything from the online store and point-of-sale systems to back-end logistics and capital lending. Their business model is split between subscription solutions, the recurring monthly fees merchants pay, and merchant solutions, which is primarily the cut they take from every sale processed. This is the real growth engine. In the third quarter of 2025, Merchant Solutions revenue jumped by 38%, largely because more people are using Shopify payments. Penetration for their payment system hit 65%, which means they are capturing a bigger piece of the pie without having to find new customers. They are growing alongside their existing users, creating a symbiotic relationship that is very hard for competitors to break. Before we go any further into the future outlook, I want to hear from you. Comment below how many shares of Shopify stock you currently hold, or if you are waiting for a specific price target to jump in. Do you think the current price is a fair entry point, or are you looking for a pullback toward the 150 range? Getting your take helps everyone in the community see the sentiment across different types of accounts, whether you're using a Robinhood trading platform or managing a more complex setup with interactive brokers. Looking back at their older reports, Shopify's story has always been about proving the skeptics wrong. After the massive 10-for-1 stock split in 2022, many thought the stock would languish as the pandemic-era boost faded. Instead, they trimmed the fat, sold off their logistics arm to Flexport to focus on software, and became a lean, profit-generating machine. They shifted from trying to own the trucks to owning the software that tells the trucks where to go. This move was a stroke of genius that allowed them to keep their high-margin software status while still being essential to the physical movement of goods. Past performance shows a company that isn't afraid to pivot when the market demands it, which is exactly the kind of management you want to see when you're looking for investment help or making a long-term play. The institutional activity in the last month has been particularly telling. We've seen firms like Vanguard and Fidelity Investments increasing their stakes, which usually precedes a sustained period of price stability or upward movement. When you see these large blocks of shares being moved, it suggests that the smart money is comfortable with the current valuation. Even with the stock-based compensation remains a talking point for critics, the actual cash generated from operations is more than enough to offset those concerns. For those using a SoFi robo-advisor or an intelligent portfolio, Shopify often ends up being a significant holding because it bridges the gap between high-growth tech and stable consumer services. Looking toward the future, the catalysts are all about international expansion and artificial intelligence. Shopify isn't just using AI as a buzzword, they are integrating it into the very fabric of the merchant experience through tools like Sidekick. This allows a single person to run a business that used to require a team of 5. By lowering the barrier to entry for entrepreneurs, Shopify is expanding its own addressable market. Furthermore, their growth in Europe and Asia is just starting to hit its stride. International GMV grew by 41% recently, showing that Shopify's model is globally portable. The risk, of course, is a global recession that finally breaks the consumer's back, or new regulations on digital payments that could squeeze margins. But given their current cash reserves of over $6 billion, they have the balance sheet to weather almost any storm. The contrast between expectation and reality for Shopify has never been sharper. The market expects a peak, but the data suggests we are seeing a new baseline. As we move into 2026, the potential for Shopify stock to test its all-time highs is becoming a very real possibility, especially if they continue to exceed guidance on the bottom line. They have moved from being an optional tool to a critical infrastructure provider.
Whether you're using a Fidelity trading platform, a Robinhood stock trading account, or managing a wealth management portfolio, this is a stock that demands your attention because it is rewriting the rules of how value is captured in the digital economy. In summary, we started today with a live price of $167.78, a clear sign of strength in a market that is often looking for reasons to sell. We've seen how the reality of Shopify's financial discipline and merchant growth has consistently outperformed the expectation of a post-pandemic slowdown. From its robust merchant solutions revenue to its strategic pivot away from physical logistics, the company has positioned itself as the indispensable partner for global commerce. While the common belief might be that the stock is too expensive, a deeper analysis reveals a company that is actually becoming more efficient as it scales. The future looks bright with AI-driven tools